Hey everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I want to talk about the national debt, which has frankly been overlooked by the general media, especially during the election cycle. I don't think a single question about the national debt was brought up through any of the debates, as many other issues were covered instead. But I think the national debt is the single most important issue that we are going to face as a nation in our entire lifetime. And this isn't to say that other issues aren't more pressing. We have the pandemic right now, which is obviously serious, but that just goes to show you how serious I think the debt problem actually is. One thing that's often overlooked is who actually is buying the national debt. Since in order to issue debt, the government issues bonds, and then in order to get the money into the government's coffers, it needs to sell those bonds to someone. Up until this year, the chief buyer of securities is often the private sector or other governments. It's usually a combination of the two. A popular buyer that people often point out when it comes to the national debt is China. China through the last decade has bought a ton of U.S. debt. With all of the money that they're bringing in through trade, they're turning that money around to buy U.S. treasuries. The same goes for a lot of people in the private sector as well. They buy U.S. treasuries since they're seen as a very stable asset. You're getting dollars in return, which are also seen as stable, so it's a relatively low-risk investment. At least that's how it's pitched, and that's how it's perceived by a lot of people. That's why short-term treasuries, those that last less than a couple of years, are considered cash equivalents, since they're considered low risk and relatively low reward as well, and rather than leave your money in cash, you have it have a little bit of returned interest when you put it into treasuries. At least that's how it was, again, before this year. And when I say treasuries, I mean Treasury Bonds, which are the main way that the US government raises money to pay for its operations when it doesn't have the tax revenue to pay for them already. Which, for the past 20 years, has always been the case. There has always been a fairly substantial deficit, and the last surplus we had was actually in the Clinton era. This means that the government has been financing its operations with a significant amount of debt every single year since then. And really since World War II, we've seen large deficits accumulate over time, since we've had a very stark shift towards debt spending and financing operations through debt, thanks to things like the Fed. The Fed, or the Federal Reserve, is the central bank of the United States, and it's responsible for controlling the money supply. It has a few very powerful tools at its disposal, one of them being able to buy treasuries on the open market. It does this by taking the currency it has, or by issuing new currency to buy those treasuries. Theoretically, when it buys the treasuries, the currency is then spit out into the economy, and people or banks or whoever can lend it or use it to spend on goods and services. Now, long ago, at the very beginning of the Federal Reserve's existence, the Fed could not issue new currency willy-nilly. It needed to have gold reserves. So unless it had the gold, it technically could not print new currency. The Federal Reserve notes that you and I know as dollars, the green pieces of paper, those are issued by the Federal Reserve. Once we hit the Great Depression in the 1930s, we really saw the Federal Reserve lose a lot of those restrictions and was able to start issuing new currency without having to have such strict amounts of gold in its reserves. This really was the beginning of the fiat currency era, which peaked in the 70s and has continued since then, when the gold standard was officially banned by the US, and instead the currency is not based on any asset, but rather is based on the value that you and I say it has. It's not based in anything else. It's fairly circular logic that a dollar equals a dollar rather than a dollar equaling a piece of gold or a dollar equaling something else. It's just whatever we say the value is, and that's what we say goes. But that's not really where it breaks down. Where it really breaks down and becomes a large threat to the monetary system is the fact that the Federal Reserve has nothing stopping it from issuing new currency as long as it has things that it can legally buy. Treasuries are the main thing that it can legally buy, but it can buy a lot of other things, and it can lend money to institutions. There's a lot of different powers that the Federal Reserve has had and has grown over its 100-year existence, but I'm going to focus on treasuries. At the end of 2019, the Federal Reserve had about $2.5 trillion in treasuries on its balance sheet. That meant it controlled about $2.5 trillion of the national debt. That's all it had control of. That is a lot of money. I don't want to pretend like it's not a lot, but it was a smaller fraction of the greater debt, which was about 20-ish trillion. I actually just checked that at the end of 2019. It was more like 23 trillion. So as a ballpark measurement, we could say that the Fed had about 10% of the national debt on its books. This doesn't include state debt, in which it does control a lot of that too. I'm just focusing on the federal national debt that people often point to, since it is humongous right now. 23 trillion was already huge and is arguably unpayable with our current fiscal system. The remaining 20 trillion trillion or so was spread among many other different types of investors and governments. I already mentioned some of these earlier, like China. Japan is also a big holder of US debt. Other countries as well, especially in Europe, that rely on the euro-dollar system. But you see a lot of pension funds, both public and private, that hold a lot of treasuries as well. So in a weird sense, the government is relying on its own debt to pay for future things as well, the future entitlements that it gives to pensioners, especially public employees that often have pretty lofty pensions depending on the state they're in. But the point is, the Fed was fairly limited in how much debt it had control of at the federal level. But 2020 is where the gloves really were thrown off. Every American knows about the pandemic that hit in March of this year. It hit other countries much earlier, but the fact of the matter is, it caused tremendous economic harm with the amount of shutdowns and then the fear and all the bad things associated with the pandemic. To combat this, the government took a bunch of stuff that it didn't actually have by issuing new debt to pay for a humongous stimulus program called the CARES Act. This was that act that gave millions of Americans stimulus checks, improved unemployment benefits for tons of people, and generally bailed out a lot of companies as well, and issued a ton of new loans. A bunch of different things were caked into this bill, and it was very expensive. It cost about $2 trillion total. But remember, the government was already running a deficit, so this was $2 trillion more into the red. But the more alarming thing that happened is that the Federal Reserve was the one that bought almost all of this debt, if not all of it, in fact. Just this year in 2020, the Federal Reserve has taken control of an extra $2 trillion in national debt. But remember, the Federal Reserve has to issue new currency in order to buy things beyond its current balance sheet. But the way it creates new currency nowadays is it just types a few digits into a computer, says the money is there, buys the Treasury from the United States government, and then the government gets that money, or at least the right to use that money in its stimulus program or whatever it happens to be. But what's the problem with this? You might think, well, that's great. The government has an unlimited pocketbook. It can just go to the Fed and issue whatever it wants to take care of the problems that we have right now in the short term. You'd be correct in saying that the government does have an unlimited pocketbook in that sense, but the drawbacks are humongous if it gets out of control. Because with all this new currency being issued, you are inherently going to have inflation. And rather than having prices go down across the board, you're going to see them go up because currency is worth less than it was before. There's more currency chasing the same number of things as before, and in fact, it's probably chasing a fewer number of things with the amount of people who were in unemployment and weren't producing anything anymore. So given the nature of the pandemic and an economic contraction, you have a dual shock. One is the fact that supply is going down since Americans aren't producing as much as they might have been before because they're in lockdown, because they've lost their job, whatever it happens to be. And at the same time, to recoup some of this demand, the government passes a massive stimulus program, and then the Fed pays for it with new currency, causing inflation. So rather than watch the price of goods go down, you instead see them either stay flat or go up in price because of inflation. In a weird twist of irony, this actually hurts those people who have lower incomes now because of the pandemic, because prices of goods are not going down with their incomes. Instead, they're going up because of inflation and all the new currency that's been printed to finance all of these gigantic stimulus programs and all of the government spending that's well beyond the government's means. So yes, the government could keep doing this, but you're going to just see more and more inflation over the long term. And also remember this, what the government really measures with the CPI and many indexes that it uses to track inflation is they are measuring net inflation, which is the difference between inflation minus deflation. At the beginning of the pandemic, we actually saw a massive deflationary spike downwards in that there was a lot less spending across the board. But all of a sudden, that spending was recuperated because of the gigantic stimulus program and all of the new currency that was put into the system. So you saw expenditures go right back up to the levels that they were before, even though the economy is in a much worse position, pretty objectively. So while you might have actually seen prices go down because of the lack of demand from the shock caused to the system, instead you actually see prices go flat, if not up, because of all of the new currency that's been issued, which maybe helps those people who have lots of debt, which is probably what the Fed is trying to do, is trying to help the invested class that has debt, homeowners. It's not trying to help poor people who don't have assets, who really are hurt by inflation more than anyone else. I'll have to do a video at some point about wealth inequality caused by the Federal Reserve's actions and the government's actions in general, since it is a major driver of the wealth divide we've seen, especially over the past 20 years. There are many factors that cause this divide, but it's one that definitely exacerbates it in a very negative way. And I say this as someone who owns real estate, who owns stocks, who has a good amount of debt that's fixed to real estate. I know that this actually helps me in that sense, but it's not as though it's great for the overall system. And I wanted to point this out because it doesn't look like the deficits are going to stop. Instead, we're probably going to see even greater deficits once we get the new administration, if there is a new administration, if it's not still President Trump, because both parties have shown that they're willing to dish out the money to pay for large programs that the government does not have the existing money to do it. So how's it going to pay for those programs? It's going to do it through the Federal Reserve, which apparently is buying almost all of the debt now. And this is definitely going to discourage investors in other countries from buying our debt, because why would they want to buy something when they're going to get paid back in dollars that are worth less than before? Because there's more and more dollars being created to pay for the debt that the Fed is now buying in droves. Anyways, before this video gets too long, that's all I've got for today. Just wanted to point out this issue and how it really is pretty troubling in my opinion, and I think it's only going to get worse as time goes on and as deficits continue to explode. We have to look at things for both their short and long-term effects, and unfortunately the way the political system works, we often only look at the short term and completely ignore the long term. Both are important. We shouldn't just look at one and not the other. Anyways, if you like this video, please give it a like since it helps the channel out a lot. If you like this sort of content about the markets, the economy, investing, and pretty much everything as it has to do with personal finance, be sure to subscribe since I post new videos every single week. And check out my book, The One Property Retirement, about a simple strategy for building your retirement nest egg using real estate. It's great for beginners who might be unfamiliar with the process since it takes you from the very beginning, from running the numbers and vetting the deal, all the way to the closing table and beyond with maintaining and renting out the property. A little currency devaluation would probably go a pretty long way in that strategy since you'd have the value of the debt being eaten away by inflation. Meanwhile, the property itself would be gaining price because of inflation, and you would end up on top. I'm no financial advisor and there's no telling what the future might hold, but it's worth a thought. And if you read the book, definitely leave a review on Amazon since that would help me out a lot. But until next time, take care.